So, guys, let me take a moment to introduce our guest for today. We have Vishal Khandelwal sir with us. He is founder of Safal Niveshak, and he has over 19 plus years of market experience. By education, he is an MBA in finance, and initially after his MBA, he worked as a stock market analyst for over 8 years with India's leading independent firm. And thereon, in the year 2011, he started his startup by the name of Safal Niveshak, and most of us are already aware of it. And he's a strong believer of minimalism, and he believes in power of compounding and margin of safety, not only in investing, but again, all aspects of life. And he talked about the best advice he has received in his journey is like the qualities of success: integrity, intelligence, and energy. And the first one, which is integrity, is the most important, because without which the other two aspect doesn't work. So he has been sharing his views on value investing in those times when it was not so much prominent in our country, and he had added value to so many thousands of investors in our uh, country, and he has been doing tremendous work. And in the year 2021, he started with a great show by the name of the 1% show, and he has hosted over if I'm not wrong, around 50 great personalities with, I mean, what we say, 20, 30 or more year of experience. And those sessions, I'm yet to cover all, but again, the sessions which I have been through are really, really very important from learnings of investing, as far as the learning which we can pass on to the generations, right? Because the only idea is not to generate wealth, but we also pass on the good things to the next generation. So with this, I welcome you, sir, and any opening note from your end.
Thank you, Prince, for this kind opportunity. I think you've been kinder to me than I would have been to myself in your introduction. I've been running this initiative called Safal Niveshak for people who are new for the last 11 years now, and yeah, it has like gone beyond what would have expected it to be when I started in 2011. The idea was clear that I wanted to get on ground and help people uh, how not to lose their money in investing, because I had seen, being an investor and analyst in the stock market, I had seen by close quarters how people, real people, not the smart guys, not the intelligent expert guys who appear on television and who write research reports and who are talking about money all the time, the real people on ground, how they lose money across market cycles. So I thought that I could use some of my learning and some of my experience to get on ground and teach them how not to lose their hard-earned money. So the journey has been good. Met a lot of good people, kind people along the way, and so that's something that I would want to start with. And thanks again for this opportunity.
Thank you. Welcome, sir. So like initially, I mean, you have told on various forums and your sessions how it all started for you, and but again, we would request you to tell us about the evolution, like when you began and how has been the journey for over 2 decades. What were your learnings initially, and on that front, would like to know from you, sir.
In essence, I think there have been two critical aspects of my journey of the last 11 years, or even the last 20 years of being in the market. So, one is luck, of course, and the other is serendipity, right? So, I never chose to be in stock markets. I was thrown into the stock markets because I had no other job to take. So, it was some other reason. I've talked about that multiple times, some personal reasons for which I actually had to take up that job in 2003 when the when the markets were just opening up in India, and we were just coming out of a big global slowdown after the 2000 .com crisis. So there were not many jobs available. The only job that came my way was that of an equity research analyst. I took it up despite the fact that it did not pay really much, but that was the only option in front of me. And gradually, and luckily, again, the reason I mention luck as a factor is uh, uh, it was an independent research company that I started working with, and I worked there for 8 years. So I was not working with a broker or any place where incentives would have driven me to go short term. So we were long term thinkers, long term investors. We were researching companies and advising people to buy and hold for the long term. Right. So that is where I also got introduced to Warren Buffett and Charlie Munger around 3 4 years down my career as after I started. And then there was no looking back. Right. I just literally fell in love with the kind of teachings, the kind of learnings that they had to share with people all around. And the best part about learning from these greats, including Buffett, Munger, and so many other people over the years, is that their learnings touch not just investing. In fact, investing is just one part of it. It's more about how do you live a good life? How do you make sound decisions? How do you avoid getting killed, like Charlie Munger says? And that's all what I've done over the past 11 years of starting on my own. 2011 is when I got started. 2008 was actually where the seeds of starting on my own were really sown after the global financial crisis. And I realizing that being an analyst and seeing all my stock recommendations touch sky because we were in the 2003 2008 bull market. So it is a market like 2008 which tells you or which teaches you that you are not the master of the universe, and there's much more things to learn, much ground to cover. So the seeds of not recommending stocks, not researching stocks, and not recommending to others, and rather doing it for myself. And the seeds of actually going on ground and teaching people the sound secrets and not losing their money. So that is where it all started. And 2011 is when I repaid my financial liabilities. And the day I did it, I handed over my resignation to my boss, saying that I am leaving. And I had some idea that I wanted to write blogs. I wanted to write about value investing, Buffett, Munger lessons, all those kind of things. But I had no idea what the business was all about, what business plan was all about, and how would I be earning money. Right? But gradually things happened. I've not really worked with a plan B. I have not. So in investing, I think long term, but in matters of working for myself, right? I don't really think long term in that sense because I make my decisions on a daily basis. I am just focused on what I am trying to do on that particular day and how I can improve myself and how I can contribute to others and be useful to others on a daily basis. And that one step by one step, one day by one day, one subscriber by one subscriber, uh, I've moved. So that has been the long and short of my journey. So luck and serendipity all the way. So yeah, I hope that answers your question.
Yeah, it do, sir. So, sir, like when it comes to writing and investing, which came first and how it has evolved in the journey? So, I mean, writing must have helped you on the investing front. So, which came first and how it led to you writing three books and there is one book in the pipeline. So, would like to know about that, sir.
So writing definitely came earlier because I have been writing for myself for almost like 30 years now, right? Initially, there was no way I could have published it because the writing was so horrible and we did not have platforms where we could have published anyways, right? So, but when I started on my job, right, my job was to write reports. My job was to research companies and write articles about investing, about companies, results, right, investing behavior, all those kind of things. So that is how I gradually sort of honed my skills in writing. I took up a course, a small course, a long distance course, in fact, in 2010, just before I realized that I had to quit and do something on my own by combining my writing skills and by combining my investing skills. So I took up a online course uh, in 2010, and that really helped me. Writing has evolved over a period of time. I still have a long way to go. But I think the biggest lesson which I have learned writing so many years and also investing so many years, like Buffett says, that your investing feeds into your business skills and your business skills feed into your investing. And if you also note that the best investors in the world, including all these guys that I've talked about, they have been great writers as well. So writing for me is a tool to think well, is a tool to think better about what I am doing in life, how I am investing, what kind of decisions I'm making. And even till today, I must have written almost more than 1,500 articles on my website telling the same things again and again. right? But the point is that each time I write it down, I am not thinking about 90,000 people who are going to read it. I am thinking about myself. I am thinking about that just one person who is like me, who is going to benefit from that writing. Right. So these are like notes to myself, which I write on a daily basis and which I want to share, which I like to share with others, thinking that there are maybe some people like me who are in a situation when I was in 2003 and 2011, not knowing what to do, not knowing how to invest, not knowing where to go, right? As far as getting honest, unbiased advice on investing their money, right? So there are a lot of over a period of time, since you are in this space as well, right? You realize there are a lot of people who have started doing financial literacy stuff and who've talked about value investing and all those kind of things, right? Which is a great thing because uh, the world needs a lot of teachers on money and finance and decision making. But I think the way I try to differentiate myself is just to be honest with the kind of work I'm doing and not do that work uh, under the garb of selling something, right? So that has helped me remain honest in the kind of things that I write, and not for the sake of writing and not for the sake of selling anything. But yeah, so there are a lot of lessons. Some of them I've shared with you. Yeah, I hope that helps.
Correct, sir. So I heard you say that you do not believe in goals, or maybe not a goal-based person, but how you can manage discipline in building a process without a goal in mind? So how you go about it, be it investing or any other facets of life?
So I would talk about that, but just let me, I think, share a small story which I shared on the blog some time back for the benefit of listeners. So there's a story of a martial arts student who wants to learn actually martial art and who goes to a master wanting to learn martial art, and he asks the master how many hours or how much time would it take me to master it, and the master says it'll take you 5 years to master this skill. And then the student asks, but what if I train for 10 hours a day? How much time will it take to become master in this skill? The master says, now it'll take you 20 years. And the student was a bit surprised. If I'm putting in more effort, how am I taking more time? So he asks, what if I spend 20 hours every day and on a daily basis, how much time will it take? And the master says, now it'll take you 30 years. And the student gets angry. And he asks the reason, why are you changing, why are you increasing the time span when I am increasing my work span? And the master says, because you're working with one eye on the goal. And how can you really accomplish what you want to achieve when you have an eye on the goal, right? So the essence of this story is, and what I have practiced and what I've talked about over the years is that goals definitely matter, because if there's no finish line, we are not sure where we are headed, right? It's like when it comes to money, you need to decide how much is enough. So there is some kind of a goal at the back of your mind. But for me is just to focus, as I mentioned in the response to your first question. What drives me is the process of reaching that goal or any goal that I want to achieve, right? So if we have goal in our minds, it's always good to write down your goals, that where you want to reach in life, when it comes to money or not money. But who knows about the future? We are all doing DCF calculations. We are all coming out at target prices. We are actually trying to predict the future of companies, even when we don't know about our own futures, right? So rather than focusing on goals which are in the future and which are not in my control, why can't I work on the process which is today, which is a system which I can work on today, which is largely in my control because that is today, right? And I may reach a goal which I would have never thought about, right? So it's like verb and noun. I want to be a doctor, I want to be a writer, I want to be a millionaire, I want to be a successful investor, right? But our lives, I think, and this is my personal belief, they are verbs, right? Which means I invest or I write, which is in the present. It's not about the future, because everything else, everything we talk about becoming is about the future. We don't talk about being, which is about the present, which is about today. So that applies to investing as well, right? If you think about the process, if you think about the process of sound investing, right? Everyone wants to create financial freedom or become financially free. That's ultimately the idea why we all investing and why we want to invest sensibly, right? We all want to achieve financial freedom. But the question is, if you always have that eye on the goal, right? you will lose focus on what you can do today. So if someone wants to have a financial freedom goal of reaching, say, 10 crore rupees or whatever the number it is, right? If we lose focus on the process, and if we are only focusing on that 10 crore rupees, right? We may take missteps along the way. We may change our process along the way. We may want to become like others are becoming. Someone may be achieving the 10 crore in 5 years, and you're thinking, wow, I will not achieve it in 5 years. So, what can I do to achieve it in 5 years when you initially started with an idea of 10 years? Right. So, if you're focusing on the goal, I think that is the problem, that's the biggest problem that you get into, that you lose sight of what you are doing today, because that is the only thing not in your control, not the goal. And with the sound process, I believe, and this is what I've experienced as well, you can reach goals that you never imagined you could have reached. And I can vouch for that from what I have been able to do over the last 11 years of starting Safal Niveshak, that I never started with a goal, whether as far as my business is concerned, as far as my investing is concerned. Even when people ask me what is your CAGR, right? First thing is it's my CAGR. So the CAGR of stock price return for me does not matter. When I'm looking at businesses and I'm thinking like a business owner, what matters to me is the CAGR in the intrinsic value of the business. So if the business intrinsic value of the portfolio intrinsic value is growing at 15% or 16% at whatever rate, till the time that is happening, I am not focused on what the markets are doing and what my stock price are doing, because ultimately we know that in the long term, as Graham said, markets are like weighing machine, right? So if not now, right, I know with a great degree of probability that over a period of time, if the businesses that I am investing in are doing well and are achieving a intrinsic value growth of say 15, 16, whatever number it is, a reasonable number, over a period of time, I am going to achieve that kind of a return. But I'm not really focused over there. All I'm focused is on finding sound businesses now, which can help me compound over a long period of time. So that's my thought on process versus goals. And I'm a firm believer in process and not goals.
Right, sir. Sir, one of your interaction with Ankit, I heard you say thinking like a business owner is not easy. But how we can approach it, and I mean, everybody should think that way, that the business, I mean, wherever we are investing, we should be keeping in mind from business point of view. But how can we make these things simpler?
See, I'm not really sure if I have an answer to that. I think it's largely intrinsic, whether how you think like a business owner. Because if you have a long-term horizon, I think that is one of the key requirements of thinking like a business owner, is having a long-term horizon, because businesses for the long term, businesses are not for short term, right? So that is one reason, or one requirement of business owner. Second thing is you need to be intrinsically patient, right? Businesses don't do well quickly. They are not there for quarters. Of course, some out there are targeting quarterly growth numbers and everything, and they do everything which is around quarterly numbers and annual numbers. But most sound businesses are not like that. Business owners are thinking long term. So if you really want to match the wavelength and do as well as a business is doing, you also have to think long term. So having patience, having your own money to invest where nobody is banging on your door to seek returns or to seek money when they need it, right? And again, thinking about the process that you started with, which was about long-term investing. So if you keep these things in mind, I think that is the way I have learned. I think so. There may be some other variables as well, but these are the most important variables that I have in mind as of now, of why or of how I have trained myself to think like a business owner, and not looking again, like I talked, right, focusing on intrinsic value CAGR and not focusing on stock price CAGR is what I am focused on, right? So if you can think of these things and not get worried about market volatility, because real business owners don't get worried about market volatility. They get worried when their business is not doing well. They get worried when there are problems in terms of their business or this competition, right? But they are worried from the point of view of being proactive. How do they change their business? How do they improve themselves so that over a long period of time they're still able to grow intrinsic values and are able to allocate capital well, right? But unlike stock market investors or analysts that we are, right, we are probably on the other side of this picture. Most of us would want quarterly numbers, and we are going to question people, question managers who've been running businesses for 10, 20, 30, 40 years, right? And we're just analyzing that business for 6 months, and we go to AGMs and we go to conference calls and we throw all those kind of questions to managements as if we are running the business. So I think uh, I am not sure. One of the biggest lessons, key lessons, which I have also learned as investor over the past many years, is to empathize with managers. Right? I am just an analyst. I'm just an investor. Right? Like investors choose managements, I wish there were ways that managements could have chosen investors. And I think Buffett has talked about a lot of this in his letter when he was running his partnership, right? He was choosing his investors. When you are managing money for someone else, you can choose your investors or people who you want to associate with. In the same way, if good managements were allowed to choose the investors, I'm sure a lot of people would have been out of the ecosystem. A lot of investors would have been out of the ecosystem because a lot of investors are not really investors. We are speculators, we are traders. We are there for paper gains and not really for intrinsic value growth. So thinking about uh, being owners of businesses is a skill. I think it comes with experience. It comes with making mistakes. Nobody can teach you in a classroom. But I think if you again if you focus on the process and if you're thinking long term, I think that skill can be attained over a period.
All right, sir. Sir, human behavior is largely same, be it 20 years ago and now. But again, the noise or I mean the inputs or the feeds which we are getting in these days is creating so much of FOMO in on the investing fraternity. So how one should sail through this because everybody getting so many ideas on daily basis, so they act on that. And in your interaction with the Kuntal Shah, sir, the 12 equations of life, one equation was like return is inversely proportional to motion, right? The more you act, and the chances are your return will decline. So how one should go through it, and how one can sail through it?
I think there are two ways to it. One you have to be wired for it, right? So again, it is not something that can be taught. You have to be wired, be patient, and avoid all the stuff which is not relevant to your investment decision making. And second, I think a more simpler way, probably not simpler, maybe a more difficult way, is to just cut the noise, because the root is the noise, right? If you just cut the noise, if you avoid newspapers, if you avoid media, if you avoid, uh, 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 probably it may sound blasphemous, right? If you avoid going to every AGM and conference call where in today's world every information or critical information about a company is available in public, right? And we all seeking perfect information before analyzing while analyzing companies before making investments. If you give up that idea of seeking perfect information, if you have a long-term horizon, if you cut out noise, which is as I think someone said, noise is to the mind like sugar is to the body. It's poisonous, it's dangerous, right? So when you cut it out from your life, and then again, when you are not focused on short-term goals, but you're focused on the process and you focus on intrinsic values for the long term, you automatically gravitate towards avoiding noise, right? So people say, but Buffett reads newspapers, right? So how can you say avoid newspapers? Right? You can, if you have the ability to separate signal from noise, right? So newspapers can give you some signals. Every information has a shelf life. If you can focus on information that you receive which has a long shelf life instead of something which is having a short shelf life, I think you can cut out a lot of junk from your life. Most news that we have, most information that we have is all short shelf life information, right? So if you focus on what is ephemeral, which is long lasting, and if you avoid what is sorry, if you focus on what is enduring, which is long lasting, and if you avoid what is ephemeral, which is all short term, I think you will automatically do. So it's all about, see, it's all about systems again. This is the reason I focus on process and systems and not goals, right? So system includes avoiding noise. System includes in being patient. System includes looking at a business owner rather than a stock picker. System includes owning businesses which are there for long term and not businesses which are fancy and which are hot, right? And which are the flavor of the season, right? So everyone can have a different process and a different system. So I'm not denying that, right? People can do great as traders as well. People can do great as speculators as well. But I I am not that smart. For me, I would go with or go into areas where the base rate of success is high and the base rate of not dying, right, is high as well. So for me, that's the reason I focus on a long term mindset kind of a game. But that's the reason I think on owning businesses from the long term. That's the reason I focus on value investing, because that is, or this is the area where I believe, and I think studies have proved, where the where you're focusing on capital preservation. I think that is all you need to do well over the long run. You don't need any fancy strategies. You don't need to focus on too much alpha, right? For most people listening to this, and for most people out there in the stock market who are not professionals, I think focusing on just being an average and just earning the market average returns is a great idea than focusing on being alpha. So everyone wants to beat the market and beat the other players at it. I think that is a wrong goal, right? If you can just focus on being average in an age where everyone is chasing alpha, you will automatically cut out a lot of noise and a lot of stress in your life.
Right, sir. So, sir, if we ask about the investing, like you believe in top-down approach or it's purely bottoms up, you identify few ideas and go deep dive in those ideas. How you
Are
go
we still
about it?
there? Okay, so I see a question about how much money one should have to only focus on investing. Okay, okay, so that's, I think, a tough question to answer. Uh, I I understand that you want to become a full-time investor and how much money you need to become a full-time investor. I think that's the question that you want to know. Uh, One thing is, people who come to and people who ask me about or ask this question of how should I become a full-time investor, right? If you're not getting into managing other people's money, I think you should not aim to be a full-time investor, because it's a very lonely job. And since we get to boredom easily, we end up making a lot of mistakes, right? So they're very rare people who can become full-time investors and manage their own money sensibly. Most of us are not wired to do that. A better idea would be to work on things outside stock market, create savings, and invest that sensibly. So you can apply your investing lessons to invest your money sensibly, money that you are earning from things outside stock markets, right? And the problem with becoming full-time investor is that it's a pretty risky thing, because your financial capital is in the stock market, and your human capital, which is your skills, are in the stock market, which means you are too concentrated, right? So you need to diversify a bit, which means you need to separate the financial capital from your human capital. Now, if someone would wonder, what am I doing if not doing the same that I am teaching people about investing, and I am also investing in the stock market, right? So now the response to that is, I am teaching people about investing. I am not a full time investor. I don't spend a lot of time on investing, though I invest most of my money in stock markets. But I earn my money by running courses, by writing books, by having workshops. So my source of revenue is slightly diversified from the stock market, and that is the way I look at it. You have to, if you really want to become a full-time investor, you need to at least have one, if not two, experiences of dealing with severe market cycles, severe market crashes, right? And not losing your sensibilities. You must be managing your own money. You must have enough money to take care of your household, because you should not be focusing on the stock prices to run your households and take care of your dependents. So you should probably have another source of income or a passive income to take care of that, right? And you should be a well-behaved investor and not a trader. A lot of people ask, again, another question, a related question is that, in the initial period, how do I build my capital, right? My capital is small, and how do I build my capital? And they'll give examples of what Buffett did during the initial part of his career, and what someone like Rakesh Jhunjhunwala did by trading and building his capital and then putting that money to use to invest, right? Again, my question may sound a bit odd to a lot of people, but my counter question is, why do you really want to build capital from stock market to make it big, right? You can always build capital by saving your money, by working hard, by creating properly an alternate source of income, rather than focusing on creating that capital by trading in the stock market. And you think that you are going to create capital that you can invest, right? I have not really seen many people who've been able to do that. So if you found someone, probably you suffer from survivorship bias. Focus on your work outside stock market, save ample amount of money, and use that money to build wealth and to invest in the stock market, rather than trying to trade in and out to create a capital to invest more and more money in the stock market. So that's my idea, and that's my answer to one question which was asked and one related question. So Prince is back. Prince, can you ask your question?
Am I audible to you, sir? Pramesh, Yogesh, Gaurav, you can unmute and ask your question. You must be audible to sir.
Yeah.
Yeah,
Okay, Pramesh, go ahead, please.
thanks, Rajesh. Vishal, what is your style of investment, and how do you define it in terms of identifying the businesses that you want to invest
So style, I would not really. So my style is value investing, if that is the word that I can use for it. So buying businesses for the long term, thinking like an owner, not paying too much of a price to buy businesses because I'm thinking like an owner, right? And avoiding the things that can kill me financially, right? So that is part of my process. That is my style. If I were to use these terms, how do I go about finding such kind of businesses? I think there are two ways. One is you. First thing is you want to go about finding businesses that can kill you, right? So finding those businesses which are majority out there in the market of India as 8,000 plus listed companies, not more than 50 or 60 companies would come into my universe, right? To be very generous, not more than say 6, 70, 80 companies would come into my universe of high quality businesses that I would want to invest in for a long period of time. And I may invest in some of them when I think the valuation and the pricing is right. So I would look at high quality businesses which have a long runway of growth, businesses which are selling simple products and services and not prone to disruption. Though in today's world everything can get disrupted, but someone has seen a business owner or business which has seen multiple market cycles and has done well, is a market leader, or at least among the first three in the markets, has low leverage on the balance sheet, which means there's not much debt on the balance sheet, because I am personally very wary of balance sheet debt on my balance sheet. So I would also look at businesses in the same way. Businesses which are earning return on capital more than 20% and sufficiently more than the cost of capital, which in India is around 11 to 12%. Businesses that have seen sales and revenue growth more than 10% in the past, and I expect them to grow over the long term because I think or I believe, based on my understanding, that they have long runway for growth. They have the capacity to suffer bad times, which again is related to having low leverage on the balance sheet and a good operator owner management, which has been good at capital allocation in the past. So looking at such kind of businesses, which are very few in India, and avoiding everything else. Also avoiding businesses which are outside my circle of competence. Some industries out there which I have talked about in the past: banking, financial services, pharma, chemicals, some business groups which I don't trust. Right. So if I just avoid things that I don't understand, things that I don't trust, uh, I am open to looking at everything else based on all these quality parameters which I mentioned. So that is my process and that is my style of investing.
Thanks, Vishal.
Yogesh, you can unmute and ask.
Yeah, am I audible?
Yes, Yogesh,
Yeah,
you are.
yeah.
Yeah, yeah. Hi, Vishal. So, two things. Don't you think the word or the concept of full-time investor itself is an oxymoron, because it then contradicts what you earlier said? Because I fail to understand how can one be a full-time investor. I can understand full-time trader. So, because the value investing and investing by definition isn't it long term? So, there is a question of being full-time involved in it. That is one. Second is
So let me answer, Yogesh, let me answer this
sure.
question. And that's the
Sure.
reason I said that I don't believe in people becoming full-time investor. Because I don't think personally myself that investing should be a full-time activity.
No, no.
Uh,
Yeah, I agree. I'm not disagreeing with you. That's what I'm saying. That I think it's an oxymoron. It's like saying I'm happily married. I don't think there is something anything like full time investor. Uh, I agree with you, Vishal. And the second point is value investing. Is it okay if you associate it with mutual fund investment, or is it necessarily only for direct investment? Because for compliance reasons, not all may be okay or permitted to invest directly, and one has to necessarily then look for a value investment scheme. What is your thought around this?
no, I think, if I again take a leaf out of the books of Buffett, he says that all sensible investing is value investing. So value investing is just a term. If you are investing sensibly, or if you're picking out good quality mutual funds out there, right, you are investing intelligently, you are investing sensibly. The definitions or the qualitative parameters of identifying good quality businesses and all those kind of things and the right valuations may not apply here, because here you're not in control of the kind of business that the mutual fund manager is picking up and what is the time horizon, what valuation he or she is paying, right? You have no control over there. But then you also look at a mutual fund manager who's also long term oriented, who's also managing that fund for a long period of time, who is, or probably the mutual fund company or the mutual fund team who has delivered returns over a long period of time across market cycles, which means they have been good capital allocators. So some of the principles of value investing apply over here, but again, if you're doing it sensibly, we don't need to use the term value investing. It's simply sensible investing.
Thank you, Vishal. Thank you, Prince.
Vishal sir,
James,
am I audible now?
yeah, you are audible now, Prince.
Okay, thank you. Great. So, Dilip, you can
Y-
quickly unmute and ask your question from Vishal sir.
Yeah, yeah, Vishalji, you are great. Like we all are, your great friends. Sir, I have like a basic question of value investing. Is like ITC was a very hated stock in around 200 when people are hating. So at that time, personally, your perspective, you are investing. I mean, not you can say yes or no, but I'm just I want to know that industry or good business in a bad phase is a good time to invest, or something when you realize that time is good at that time investing is a good idea.
I think investing in a company, a business where in today's world, first of all, it's very rare that you are the only person who knows about the long-term future of the business. There are a lot of smart people out there, and intelligence anymore is not an edge for you, right? It's largely how you behave and how long you own your investments. Think like a business owner. That's the only real edge which is out there. So, finding good quality businesses and owning them, even when the markets are not thinking, or probably more other investors are not believing that story. But if your analysis tells you that this is an investment worth owning, I think that's a good idea. The counterpoint to that is that sometimes being too early is also a mistake, right? You may be buying into a business which may not really do well. I'm not talking about stock, I'm talking about the business, which may not really do as well as you had anticipated when you bought it. Probably you need to have a horizon of say 3 or 5 years, and that's the amount of time that you want to give to the business to keep owning without worrying about the stock price. But if the business does not do well for even 3 years or 5 years, then you need to probably rethink your thesis. Just to give an example of Microsoft, and not not talking about ITC per se, but just to give an example of Microsoft, 19, I think it was 1986 when the company came out with an IPO, and by 1997, before the dot-com boom actually started, Microsoft was already a 100 bagger. And people who owned Microsoft in 1997, who also bought in 1999, it was a great business, right? But people who bought in 1999 ended up with 0% return over the next 17 years. Of course, there would have been very rare few people who would have owned Microsoft and who would have bought in 1999 and held on till 2016, after which the business skyrocketed and did well, and Microsoft changed its business, and the stock has done wonders for people, right? So there would have been very rare few people who've been adamantly holding on to Microsoft for 17 years with 0% return. But again, people who would have had a process in 1997, 1999 would have bought Microsoft for a different reason, which was the operating system, Windows. People who would have sold off Microsoft in 2003, 4, after 3, 4 years of not earning return and the business not going anywhere, would have sold off because they realized that the business is not doing anything. Microsoft is lagging behind other companies like Apple and Samsung in terms of tablets and new mobile technology. And people who bought again in 2017, 18, 19, maybe, if not in 2016, would have bought again because they realized that Microsoft has changed its business fundamental and is now supposedly moving in the right direction. Right. So if you have a process which tells you that the business is good and if the markets are not realizing it, then you can still own it. But don't be adamant. I would say I would give you a number of say 3 to 5 years. Beyond that number, if the business continues to frustrate, if the business is not doing well, if the stock is not doing well, but the business intrinsic value is rising, you can still own it. But I would still have a number of say 5 years to see that the market is probably seeing something that I am not seeing, right? And sometimes we need to be humble and accept that the market may be right and redo our thesis. So I think that is my 2 points on your response. I hope I have not confused you more.
Yeah, yeah. Okay, okay, sir. Thank you.
I
So
tried.
there is
Thank
one
you.
question, Vishal sir. The question is on technology, not only IT, but technology in any space is changing very fast. How do you see technology-oriented companies doing better in future?
So I think your question has the answer. Technology is changing so fast that I have no idea about how the world is going to look like even 1 year, 2 year, 5 years down the line, right? We were talking about spaces. Spaces was gone yesterday. Spaces came back today, right? So we are not really sure what are the people who are running technology are going to do with how the businesses are run and what kind of things people do and not do with technology. As far as Indian companies are concerned, uh, I think there's a great potential out there because Indian companies, if you look at Indian tech space long term, there are very high quality names out there, and uh, we are still the back ends of the world. We're still not the front ends. So, in one way, it is not good because though Indian companies have moved into tech companies have moved into consulting in some way, which helps them earn better margins, better revenues per man hour. But we're still largely a back end to the world, which safeguards us against major technological disruptions because we will still be backends even when technologies change. So I have hopes on Indian tech companies both moving front end and also continuing to do the kind of back end work at low cost for the world. So because that cost arbitrage is not going anywhere. It may come down because there are a lot of competitors out there, but long term, I am positive on high quality tech businesses out there in India.
So Kanan, you can unmute and ask your question.
Yeah. Hi. Thanks, Prince Pai, for getting me as a speaker over here. And first of all, Vishal sir, I would firstly like to appreciate the work that you're doing at the Sapal Niveshak blog that you're writing. In fact, the blog that came a couple of days back, I guess you quoted Mr. Thomas Edison. It was really inspiring for me because I was, lamenting about a mistake that I made a few months back, even till date. So really nice work that you're doing for educating investors and newbies like us. So, sir, my question is around the valuations basically, since we are talking about tech and value investing. So if we, of course, I don't mean to be stock specific. I'm just giving examples just to make myself clear. So if we talk about a stock like Alphabet, a few days back it was trading at a price to earnings multiple of 18, say. And if we talk about companies like HUL and all these, top companies in India like Nestle and everything, they trade at 80 multiples of 80. And still they, over a 5 year, 10-year period, they still become multi-baggers. So I, of course, understand the difference that technology is very volatile and as just you said. And if we talk about companies like HUL and Britannia, Nestle, they are not diminishable as or perishable as technology is, right? So, of course, there are threats to tech, but still a giant like Google trading at that valuation. Whereas if we talk about FMCG top companies trading at that kind of 80 kind of price to earnings multiple with just volume growth of 4 to 5% and the rest being covered by the price growth. What's your view around this, like the valuation of these top FMCG companies of India?
So thanks for your kind words, Kanan. I think one reason which I see, of course, is as you said, technology is changing frequently, and people are not really so sure compared to a more stable business like HUL or FMCG in India. So that is one reason in terms of business stability. I think a second and a very important reason is also about demand and supply. Right? Yeah, US has, I'm not really sure, maybe 25, 30,000 listed stocks out there, and there are a lot of stocks to choose from. Plus the amount of liquidity which is there in stocks like Alphabet and all those kind of businesses out there is much, much higher compared to liquidity available or the demand versus supply equation in India. India has very few, a limited number of high quality businesses, very few compared to the US. So when there are so much money chasing so few assets, right? Demand versus supply. When you have less supply and more demand, the price is going to rise. So valuation in India generally of high quality business has risen over years, and I would say that they are I would not use the word permanent, but they are going to be high compared to historical standards, and also compared to all these names that you take international businesses out there in terms of price to earnings. Uh, One thing which I have learned over a period of time is that uh, we need to differentiate between value investing and what is called the value factor, right? So value investing is simply buying something worth 100 rupees at say 80, 90 rupees, and not 50 rupees like Graham advised, because you're not going to get anything which is of high quality at 50 rupees in today's world. You may get even something at 100 rupees or 120 rupees. So you buy something worth 100 rupees at say 120 rupees, but not 200 rupees. Value factor is a low PE, a low price to book value, right? So the returns, and I'm not really sure where I saw that, but historically, the returns for strategies that employed the value factor and they bought stocks at low PE and low price to book value, the returns have fallen over a period of time. But the returns on businesses where the intrinsic value has risen and people have still not overpaid but paid up for high quality businesses, that return has increased over a period of time. Right? So we need to differentiate as investors whether we are looking at the historical standards of price to book value, because in today's world, a lot of value is not in the books, right? There are a lot of intangibles out there. Brand is there, employees are there, services businesses out there, where you don't have the real assets or real productive assets on the book or the balance sheet of the company. So the book value or the price to book value will always look inflated. The price to earnings is always going to look inflated out there, right? So if you can differentiate between the value factor and not go by buying cheap stocks or cheap looking stocks, but instead look at businesses which are high quality and which are trading at certain times and not always lower or almost at par compared to the intrinsic values, I think that is something that I would like do myself in terms of in the pursuit of higher returns or good returns, inflation beating returns over a long period of time. So I think that answers your question, I hope.
Yeah, yeah, that
Yeah.
was really great, sir. Just a small follow-up question on the thing that you said about liquidity. So, as if we see, quality businesses rising in India in the days to come, so can we expect the PE contraction in these kind of stocks? One, and second, antithesis to this point might be that the financialization of savings in India is quite low, right? So as it increases, if it does, then this thing might be set off. I hope you got my point.
I got it. There are more people buying stocks. There are more people with demat accounts and more people coming to financial markets. So of course, we saw in recent times how if I were to go back when I started investing, or even 10, 15 years back, FIs were the people who actually controlled Indian markets. In today's world, you have so much money with Indian mutual funds, or so many people investing in India, or domestic money, which balances or probably more than balances any FI outflow out there, right? So with financialization of savings, we will see valuations remaining high. The good thing is that because there's so many people out there who come into the stock market, and especially the portion of people who don't have experience of dealing with bad markets, right? We will also see cycles. So the cycles are not going anywhere. If you are maintaining watch list, if you are doing your work carefully, you will find those small pockets of opportunities like we did in March 2020 for some external reasons or some valuation reasons out there. So there would be pockets of opportunities which would be short lived, but there would be opportunities to buy high quality businesses at not cheap but reasonable valuations. And so I think we are going to see something like that continuously going forward. What was your first question?
So, sir, my question had actually two parts. So, second was around
So
financialization of
yeah,
savings, and the other one was like linked to that only. So, my question was that as you talked about quality businesses in the US are more than that in India, right? So, I was asking if at all the quality businesses in India improve, which are listed on the stock exchanges, will we see an offset of savings being moved from these stocks to other value businesses, and as a result we see value PE contraction in these kind of valuation contraction in these kind of stocks. But my antithesis pointer was the one that you just answered, that
yeah.
financialization of saving is less in India, but it can be offset by the even if we get higher quality businesses in India?
No, I think there's a saying. So, answering your first part of the question, there's a saying in real estate that they buy land because they're not making land anymore, right? So, in the same way, I would say that they're not making quality companies anymore, right? So, there may be one or two rare companies which are out there who come out in the stock market and get listed, and people may buy it. But if you look at global numbers, right, the average or the life of an average company or average life of a company has come down from 60 years, say, for 30-40 years back to just around 15 years now. So on an average, a company survives for only 15 years in today's world, but this is on an average, right? So I don't really see a lot of quality companies coming out or being built anyways, because I don't know, maybe my personal opinion, but I see too much short termism in the market and too much short termism in business, unlike what it was 20, 30, 40 years back, where people were thinking long term. And if you're looking at the startup ecosystem, and if you're looking at new businesses coming in, I don't see people with long-term visions. I see people who want to raise money at whatever valuations, not focus on profitability, come out with an IPO, cash out, right? And then write books how to start a startup, right? So I don't see much quality into the market. So that is I would not say scary, but that's a difficult environment for any stock picker to identify high quality businesses that are also trading at reasonable valuations. But of course, since India has a lot of opportunities, India has a lot of growth, and if you move beyond the top tier names, there are a lot of opportunities in the mid and small cap space as well. So if you keep searching, you will keep finding some of the opportunities here and there. And I think the idea is to find that one single opportunity once a year. If you can find one opportunity every year, I think your work is done. And if you are really lucky, you will be able to find two opportunities in a year. So if you can just focus on that, finding one single good business to be held for long term once a year, I think that should be enough. And India has a lot of such kind of businesses, at least 100 such kind of businesses that you can buy from time to time.
Great. Thanks, Kanan, for your question.
Got it.
So,
Thank you.
Vishal sir needed to ask how good we are on time. It's actually 1 hour, so we have many questions left. So, how should we go about it?
I am a long term thinker, so I have a lot of time. So don't worry about that. If I
Great,
commit,
great, sir.
I have a lot of time.
Okay, great, sir. So there is one question from Anup. He's asking how you view new age businesses from the shelf life point of view, irrespective of IPO or current market price, especially Indian grown startups, how we should approach value investing in such cases.
See, value investing, again, going by the fundamental aspects of value investing. If you just were to, if you really were to take Ben Graham's original definition, which I think still stands true, you need to expect reasonable return. You need to understand what you're getting into, and you need to have that idea of safety of principle. I don't see that aspect in the new age startups. I don't see. So again, I'm not saying you cannot see, but I don't see that aspect or that that idea of applying value investing to Indian startups. Again, as I mentioned in my previous response, we are living in a world focused on too much short term, right? So if I find a business owner or running a startup who's thinking long term, first thing I would be knowing him or her personally, right? So I can act like a venture capitalist if I have too much money and I'm willing to lose that part of money 100%. If I really want to bet my money on startups and new age companies, either privately or in the public markets, I would use just maybe 5% of my capital to do that. I would not really use my core capital or the money which I may need for my financial goals 10, 15, 20 years down the line. I would not use that money to invest in businesses which have not proven themselves. Again, as I mentioned, this is my way of investing, and you can be different and you should be different. So if you are really wanting to invest in new age businesses privately or again in public markets, think of yourself as a private equity or a venture capitalist. And like a venture capitalist does, right? He or she owns multiple businesses, and one of them or two of them will do wonders for them, right? So if you get lucky, you will hit up on a jackpot. But you, when you are investing a small amount of money, you are investing with the idea that you would be fine even if you lose 100% of it. So if you can think that way, and if you have that kind of money which you can lose permanently and a small amount of that money and not your core capital, then I think you can still bet on some startups that way, because I'm sure a lot of at least a few Indian companies are going to create wealth going forward long term. I am not able to visualize them because I'm not able to see profit. So I need to combine the narratives with numbers. That's the kind of investor I am. I see not a lot of narratives. I don't see the numbers. So till I don't see numbers, I would not invest in the narrative personally. But you can.
Right, sir. So there is one question from Ankit Verma. So he's asking, what is your view on comparison between diversification and highly concentration? So he's saying, I am a big fan of Charlie Munger, sir. He is highly against diversification. So after reading him, I also became highly concentrated, but many big investor or fund manager talk against that. What's your view on that?
See, again, it's a good idea to learn from these grades, right? But how do you apply that to your own personal financial life is a different idea altogether. Charlie Munger can be concentrated, right? And he can still survive in the sense that his financial goals are all met, right? He is rich enough. If you're rich enough and you can survive your stock portfolio going down the drain, you can take the risk of being a highly concentrated investor. And I'm not saying it's a bad thing. What I'm saying is that, again, all I say is all I practice myself, and things which based on my experience and learning really work for most people out there. So I this is not an individual answer, this is more a generalized answer. A way to mix concentration and diversification rather than only focus on concentration, because there you should be willing to lose your money permanently in at least one or two stocks if you're only concentrated in say three or four stocks. I've known people who've gotten rich by just owning one stock or two stocks, but that's perfectly fine. Those are survivors, right? So we need to get over that survivorship bias and look at so many other people who also concentrated and now lost everything, right? So a way to mix concentration and diversification for me personally is to have say a 15 stock portfolio, 15, 1 5, not 50. So 15 stocks or a 10 stock portfolio. You concentrate among your top or the highly most convincing ideas. So for me personally, I would generally go, my top five ideas would be around 70-80% of my portfolio, and the remaining 10 ideas would be another 20% of my portfolio. So I concentrate among my best ideas and I diversify among my second best ideas. So that's how I mix concentration and diversification. A lot of people again use this quote uh, saying that concentration helps create wealth and diversification helps preserve wealth, right? But concentration can also backfire and backfire massively for you. So be aware of what you are doing. Again, investing is a very individual game, right? It's a game that and you are trying to win it, right? So I would not go into concentration just because Charlie Munger said it. I would look at my personal financial life. I am going to look at how much can I lose and still survive. So what's my capacity to suffer bad times, and then I am going to decide whether I want to highly concentrate or I want to mix concentration diversification. But if it suits you, do it, but have enough margin of safety that in case things go wrong, you are not destroyed financially. So for me, prevention of losses is more important than pursuit of gains. You may think that they are both the same things. They are not. It's just the mindset. So if you have that mindset of pursuit of gains, you can concentrate, but I would still advise to take a relook at your investment portfolio, your risk profile, your capacity to lose your money permanently, and then decide for yourself whether you want to really concentrate or you want to mix concentration with diversification.
Right, sir. So before coming to novice, one question is from Denny. He is asking how comparison affect investing behaviorally.
Comparison.
Right.
So you're saying comparison? I didn't get you. Comparison means what?
Comparison as in like if other say us you see other person's portfolio or maybe someone in your network you're seeing and we compare ourselves that our
Even
investments are not doing.
So I
Yeah.
got your point. So even Newton was not immune to it. We know the South Sea bubble and Newton's story, right? So for people who don't know it, the Newton invested in this company called South Sea in the 1700s, and he knew a lot about South Sea. He was a rich person. He invested a large part of his net worth. In 3 months, South Sea multiplied three times, and Newton was like surprised. He said his wealth was multiplied 3 times in South Sea, and since he was a very smart person with supposedly the highest IQ in the world, he sold entire South Sea holding and came out and he said, I can calculate the motion of stars, but not the madness of men, because that was madness, right? But Newton's friends did not sell South Sea and the stock kept on rising. So what happens when you see your friends getting richer faster? You fall into that bias of envy, right? You suffer from envy. How can I see my friends get richer faster? Let me also do something. Right. So Newton got in at the top and he lost everything that he had. Also his reputation as an investor. Right. So comparison is a trap. Comparison leads us to envy. And envy, as Munger says, is the most stupid sin, because this is the only sin where you don't enjoy even when you are indulging in it. Other sins you can enjoy when you are indulging in, but not in envy. So why even envy others? Because we are managing our own lives, right? So that is the problem with too much noise and information and being on Twitter and looking at, and in today's world, it's all out there, right? The reasons of or the ways of creating envy is all out there. Now we have people who are verifying PNLs, right? So and people are posting their verified PNLs out there, how much crores I made and how much crores I lost, and that takes you, even if you don't want to, if you keep looking at such kind of things and such kind of riches which people are achieving in quick time, our brains are not wired to make rational decisions. We are going to rationalize anything that takes us into that kind of a gain as well, and quickly. So that's the reason I said in a previous response, if you just cut the noise, if you just avoid all the trap which is out there in terms of too much information, too much riches out there, too quick riches out there, right? You would avoid a lot of envy out there, a lot of comparisons out there. Buffett uses the term inner scorecard, right? There's no outer scorecard that you need to live by. Who wants to show a CAGR? And why would you talk about your CAGR? It's your own financial goal. It's your money. It's the way you invest, right? So do it that way. You would want your kids to avoid envy. But the problem is when it comes to money and our investing, we all fall into that comparison trap, because that's what we've been grown with, right? Grown up with. When initially it was about marks and grades, then it was salaries. Now it's about investing, and it's about followers as well, right? Uska follower made se kaise zyada ho gaya. So it's all out there. You just need to cut the noise, you cut the root, and you cut a lot of problems out of the life.
Right, sir. So, novice investor, you can unmute and ask your question.
Yeah, Vishal, first of all, thanks for bringing in, lot of sanity and balance for, layman investors like this when a lot of noise is there. My question is regarding the index funding, investing in the index funds with few stocks, lifting the index to very high levels, and also lot of fresh money chasing index funding every month in terms of SIP, etc. So for a layman like who is not a full-time investor or not uh, an expert, so investing in index fund, how do you view that space?
So if you look at the other side of it, which is active investing, right, where the fund manager decides which stocks to own and which to sell, right, you see 89%, I think that's the number, 89-90% of active money managers underperform the index, right? So people who want to chase alpha and who are the smartest guys out there as far as chasing alpha is concerned are not even able to earn that alpha, and not even able to earn the average, which is the market returns. So I would I I have actually changed my mind a bit on index investing in the past 10 years. If you go back to my archives, I wrote an article of why I don't believe in index funds maybe 8-9 years back, because of high cost of ownership and the way indices were constructed. And maybe 7-10 years back, there were only funds which were tracking the census or Nifty. So in today's world, you will also have funds which are much more widely tracked in terms of they're tracking a wider index, a bigger index, a broader index, which captures a bigger market cap as far as India is concerned. Also, the cost of owning index funds has come down to, I would not say near zero, but close to zero, right? So, if 89% or 90% of active fund managers are underperforming the index, owning the index is a good way, right? India still has a opportunity where there are good money managers, there are opportunities of active investing or doing well, at least for some more years, right? So, index fund for me would be just one of my funds, or one fund which I would be owning, apart from maybe two or three other active schemes out there. But largely because costs have reduced a lot compared to active funds. US is seeing a problem because, as you rightly said, they are betting on a lot of index funds are actually, I'm not sure, they own 50% of the market, more than that. So those people are calling the shots out there. Not the case in India as of now. We still have years to go to reach that situation. But just going by statistics, if I want to beat 90% of money managers out there, the simplest thing is to buy an index. But if I can, like Monish Pabrai says, it's not just blindly copying and pasting. You also use your intelligence. If you can learn to pick those few stocks, if you can learn to identify those few good money managers who can do better than index for the next 5 years, 10 years, you can diversify across them as well. But maybe one index fund is perfectly fine for you or for anyone.
Thanks, Vishal. My second question was regarding which are the good resources which are India oriented, Indian market oriented, maybe some good books or resource. I have already purchased your, sketchbook of wisdom. So apart from that, any good book or resource you would suggest for Indian markets? Thanks.
So thanks for the sketchbook of wisdom. Anyways, Indian markets, there was again what I talk about and what I believe, things that investors should learn are the principles of investing, right? And the principles do not get differentiated between geographies. The markets are different because the nature of markets may be different a bit in terms of liquidity, in terms of size of market, in terms of the availability of opportunities out there. Right? But the principles are not any different. So I have not really seen many books or a lot of good books out there which cater to Indian markets per se. But there's a book of long-term value by Bharat Shah, which is again I think circulated everywhere. It's not in print, which is out there. Behavioral finance again is a global subject, but there was a good book written by Parag Parikh, the late Parag Parikh, many years back. So that's one good book out there. But otherwise, everyone talks the same thing. I don't talk anything any different out there, anyways, in my blogs and my books as well. So, but read the best books out there. Nassim Taleb has a term called the Lindy effect, where he says the half life of something which is not perishable, things like book and technology, is the current life, which means something which has survived for 50 years is just half the age, which means it's going to survive for another 50 years. So read books and read resources, whether India or international, that have survived ages, that have survived for 50, 60, 70 years as far as investing is concerned, or even 100 years, uh, because they are likely, the same principles are likely to work for another 100 years. So I think that is the way you learn. If there's something which I come across, I'll share.
All right. So there is one question from Gaurav Shah. He's asking if data numbers and investment thesis is playing an intrinsically it's a good idea, but market is not giving value or say fair value to the business. How to mentally sail across those situations as an investor?
I think I replied in a previous response that if you think like a business owner and if you give yourself, I don't know, I don't have a number, but if you look at say 3 to 5 years time frame, and if you really believe that your thesis is true, maybe you recheck, maybe you ask a devil's advocate, or you ask someone of a friend to find out anything wrong in your thesis. If they're still not able to find out anything, that your thesis is perfectly fine. It's only that the markets are not believing in it at this point of time, and the business is fine. Even if things go wrong, they are not going to go wrong horribly. I think you can keep patience for 3 to 5 years at least. I do that. Fortunately, I have not really encountered a business that has not paid out for 5 years. I have sold businesses in the past where the thesis, as far as markets are concerned, did not play out, and I realize in hindsight those were mistakes I've written about them. But if the business continues to do well and the intrinsic value continues to rise, and the owners of the capital allocators are not doing anything wrong, which is going to hurt the business long time, I think it's fine keeping a 3 to 5 year time, being patient about that thesis playing out. And if it's still, and you relook at your thesis maybe 3 years down the line or 5 years down the line, if it's still not playing out, maybe you need to think hard, or maybe probably need to find better opportunities out there.
So Vishal sir, let's talk about few mistakes which you want to tell our attendees so that we can also, I mean, at least relate and learn from them. Those who are just the beginners, they can be cautious about those. So what kind of mistakes we make and what is a good idea how we should go about learning from the mistakes?
You're talking about mistakes people make or mistakes I made?
Sir, both. I mean, normal. So you first talk about your mistakes in your last 2 decades of journey, and then common mistakes which should be avoided by all of us.
Then we need to probably go till 8:15 p.m. tomorrow night. It's a long list of mistakes out there. But I think I have, that's the good part about writing on a blog and expecting that nobody's reading it. So I have written about my mistakes in the past. If I were to, I can name the stocks because I have written about them publicly. One was Swaraj Engines, which I bought somewhere in 2009, and the stock was around 400 rupees just coming out of the financial crisis, and I thought it was valuable, and I sold that stock, and I held on to that stock for 3 years, and I sold the stock because in 3 years the stock price did not budge beyond 400, so 0% return in 3 years. I was following what Ben Graham said, that you should sell your stock if you achieve 50% return, or if 3 years have come to pass, whichever is early. So for me, there was 0% return, but 3 years it happened, so I sold the stock. In hindsight, when I learned from that mistake, I realized that I was not looking at the business because the intrinsic value, the business was improving even in those 3 years. It's just the stock was not rising because it was never been a glamour stock. So that was one mistake of focusing not on the stock price, but focusing on the intrinsic value. And that's the reason I'm talking again and again about the same thing, having an owner's mindset. I have bought into stocks where I just loved the glitz and glamour out there, like a stock called Hotel Leela, where I loved their hotel properties, and I realized that they were booked for the next few months. And I bought the stock just looking at that and not looking at balance sheets and income statements, and I realized later that these are very capital intensive businesses and very difficult to attain profitability. So another lesson, I sold at a loss and learned a lesson. So I have not bought a stock after that in the last 15, 16 years without going through their annual reports and balance sheets. So that's a must for me after that mistake. I have bought stocks based on Graham's idea of extremely cheap stocks, so cigar butts kind of thing, stocks that have been available at less than the net current asset value. Of course, they were very rare things, but 2008, 2008 after the financial crash, there were a couple of stocks. One of them was Arvind, and I bought that stock and realized that the current asset was actually not worth it at that point of time. I made a loss, sold the stock. So there have been stocks like these. Of course, I've been fortunate enough that I have not lost a large part of my money in these kind of stocks, and I realized my mistakes early on and moved. Uh, Mistakes that people make, I think some of these same kind of mistakes that people focus on stock prices, not businesses. People focus on short term and not long term. People want to attain, or people want to get, a lot of investors want to get that last bit of information, and that's the reason you have everyone on WhatsApp forums, everyone on stock forums, and everyone discussing businesses and stock prices and all the kind of stuff, as if you have some kind of an edge over the other investors because everyone knows the same things. So you don't have an edge, right? In today's world, as I mentioned, the only edge as far as investing is concerned is how you behave. Again, that is largely not in your control. But if you have a long horizon, so time is the real edge that you have. How long can you invest? How long can you focus? How well can you think like a business owner? Right? So business, if you look at investors or if you look at managers, right, you would always want to partner with business owners who think long term. Right? If you are an investor, if you are a trader, you are working for a profits. You are just looking at stocks as pieces of papers and tickers, and you are there for quick profits. You're not thinking about businesses at all, right? But if you really call yourself an investor, you need to first understand the definition of investing, which is to think like a business owner, right? If you can do that, you would avoid a lot of those behavioral mistakes out there. Of course, we are not wired to make rational decisions. Munger says we are rationalizing beings. So we make a decision and then we confirm a thesis and reconfirm it. And we are not willing to change our minds even when we realize that we made a mistake. Right? So that's inherent human nature. We cannot get over it. But here, a checklist really works. So if you maintain a checklist of things that you would focus on and things that can get into trouble in terms of behavior is concerned, in terms of business is concerned, like leverage, like short-term focus of business capital allocators, like too much acquisitions that they are making. So if your business passes the checklist, it's perfectly fine. You can still make mistakes, right? But again, I would not decide whether my decision was a mistake or not based on the outcome, because the outcome could be anything. I could be the most foolish person in the world and achieve a great outcome, and I can be the smartest investor out there and achieve and create a mistake, right? So the outcome, we decide a lot of our decisions or the quality of decisions based on outcomes. So I would not do that. So that's another big mistake that we make as investors, that we focus on outcomes and not on the decisions, right? So, and of course, the classic behavioral mistake of being overconfident. So there's something called the Dunning-Kruger effect, which simply says that the less competent you are, the more confident you are. And this is applicable across lives, across things that we do in life, including decision making as investors. When people are less competent, they are more confident. But over a period of time, as they gain competence and they realize that there's so much to know and there's so little that they know themselves, they they get that sense of humility. At least some people get that, and they end up making lesser mistakes as time passes. So, if you are new to investing or if you are not much experienced, remember that you may be suffering from the Dunning-Kruger effect, which is a big mistake. So, know that there is not much that you know, and that there is so much out there to know, and keep learning. That is one way to minimize a lot of mistakes. We cannot eliminate all mistakes because we are humans, but we can learn from other people's mistakes and minimize mistakes out there. And I think it was Peter Lynch who said that if you get 60% marks, or if you get 6 out of your 10 stocks right, you are very good. Just ensure that the remaining 4 stocks don't lose you money permanently, right? So aim for 60%, right? Avoid the disasters, minimize behavioral mistakes, maintain checklists, and focus on the long term. And I think you should be fine.
Great, great, sir. So, Ankit, you can go next.
Hello, am I audible?
Yeah, Ankit.
Yeah. Hi, thanks Vishal for coming here on this space. I just joined. I hope I'm not repeating any question. So my question is very simple. Uh, Today on Twitter, we see a lot of uh, SEBI registered people or maybe non-registered SEBI people sharing a lot of their stocks, and they keep giving their recommendation. And I see a lot of new investors joining the call today. What would be your advice to them? How do they uh, uh, deal with this situation today?
That's simple, Ankit. Don't be on Twitter. As I mentioned in a previous reply, if you cut the noise at the root, right, and if you are able to separate signal from noise, then you can still be on Twitter and you know what is nonsense and what is sense, right? But if you are not able to do that, especially when you are young, since you're not, right, you probably need a mentor who can help you do that. You probably need to learn what really works and what doesn't work. Short termism doesn't work. Long termism has a high probability of working. I'm not saying everything that you invest for the long term is going to work for you, but it's a high probabilities. Investing is largely a game of probabilities. There are no certainties out there. But what really works is right. Not being a smoker and surviving 99 years is fine, but being a smoker and expecting to survive 99 years, I think you could be lucky and still survive 99 years. So cutting the noise out there and not really getting worked about what others are earning and focusing on the capabilities that you have, right? I think that's the best advice that I would want to give my kids as well, or anyone who's new, starting in the stock markets. And as I think you've seen celebrities who saying about cryptocurrencies that it's not difficult, it's very easy, right? Investing is difficult, right? Buffett may make it sound very easy, right? And they have a quote saying that investing is simple but not easy. So what is simple are the rules, are the ground rules of investing, right? What is not easy is cutting the noise. What is not easy is behaving well, right? So that's it. That makes investing terribly difficult. And most of us are not wired to be investing in stocks. I think it's perfectly fine owning mutual funds and or finding a good capital allocator who can do well, who can do good for your investments. right? And for new investors, I think one test that you can take is to, and if you know something about stock markets and stock businesses, right? Give yourselves 5 years of time, create your own portfolio of stocks, and also invest in a mutual fund which you think is good, and see the performance in 5 years. If your fund manager has done well, better than you, you give your entire money to the money manager. If you've done better, you put probably more of your money through direct stock picking. But don't have that arrogance of thinking that I am the best investor out there. Probably there are better capital allocators of your own capital. If you can find them, please do it. If you are the best capital allocator, please do it yourself. But again, know yourself. I think it was Adam Smith, George Goodman, who said that if you don't know who you are, the stock market is a expensive place to find that out. So if we learn from history, if we learn from other people's mistakes, if we learn from what these people have reminded us every now and then, which really works over a long period of time, we would save ourselves a lot of pain and hardship. You'll still go through mistakes. You'll still have market cycles that are going to not ruin you, but they're going to trouble you, right? But again, some basic hygiene factor: your money, long-term money, patient capital, right? You're living with an inner scorecard and not an outer scorecard. You're thinking like an owner. You are investing only long-term money in stocks, and you are again not looking at stocks as stocks, but as parts of businesses. That's all you need to survive. And I think that's the most difficult skill to have in investing. The only thing you need to do is to survive. If you survive, you will do well. You don't need to be the best investor out there. You just need to survive. And survive on a daily basis, right? Not on an average, but on a daily basis. So that was my response.
Thank you. Thank you so much, Vishal. Thank you.
All right, sir. So next is Julian or Sai. Sai, you can quickly unmute and ask the
Yeah,
question.
yeah. Thank you so much. Thank you so much, Mr. Vishal, for actually doing this. So I just have a question regarding Swaraj engines, which I know that it was a regret for you because I have asked you regarding this already. But then my question is, I was checking Swaraj engines actually, and it's more of a technical question. So the PE was around 9 to 10 when you had sold during 2012 or 13, for example. For almost a year or two, it was around 9 and 10 the PE. But then I see that during 2017 the PE was around 40. So my question is, how do we find businesses which can actually expand their PE? That is my question.
No, you don't need to find businesses that can expand their PE. You just need to find good businesses. In the same way, you
Okay.
don't need to find future multi-baggers. You just need to find good businesses, which they may become multi-baggers in the future. They may see an expansion in PE. If the business continues to do well, right? Again, that's the same thing
Mm-hmm.
about process versus goals, which I was talking about, systems versus goals. Right? The kind of business that you find today is system, right? That's because you know about the business today, and there's some probability that you expect that the business is going to do well and survive over the next 10, 15, 20 years.
Mm-hmm.
To what
Mm-hmm.
extent the P is going to expand is not in your control. Even the business is not in your control, but your analysis tells you that the business is going to do well compared to competitors over the next 10 years. If the business can do well, the P is going to expand anyways till a certain limit, not till infinity. Right. So rather than focusing on what may happen in the future or P expansion, because a P expansion is required for a business to earn you or create wealth for you as far as the stock is concerned, but you have no idea when it's going to happen and whether it's going to happen. Right? You can create wealth by companies returning money to you via dividends. You can create wealth by companies simply growing their earnings over a period of time. Right? I've seen businesses, I've owned businesses which I initially bought at say 30 times price to earnings. 3 years down the line, the stock had multiplied by 3 times, but the stock was still available at 35 times price to earnings. So the P did not expand, but because the earnings had expanded, right? Earnings had grown, the stock market probably appreciated that. And 3 years is a very short period of time, but just to give an example. So just focus on finding good businesses today and own them till the time they remain good businesses, whether they create wealth through dividends, through P expansion, through earnings, or through a combination of these. Nobody knows. It's only in hindsight that we have multi-baggers. It's only in hindsight that we have P expansions. But the lesson from Swaraj engines again for me was that I need to focus on the intrinsic value and not stock price. So that was the core lesson. Even if Swaraj Engines would have not done well after I sold it, right, my lesson would have still been same, that I need to still focus on the intrinsic value and know where the business is going and not focus on what the stock price is doing, even it's a matter of 3 years or 5 years. That
All
answers
right.
your question.
Thank you. Thank you so much. Thank you.
Thank you, Sai. Next is Saurabh Arora ji. So you can unmute and ask your question.
Hi guys, good evening. Vishal, I'm a long-term follower of yours, a great admirer of your work. I religiously, repeatedly watch your 1% show, and quite a great work that you're doing, and have added great value to me as well.
Thanks.
My question is, when it comes to building a framework of tracking your investment, so you may have designed your own philosophy, you have your own qualitative framework, but I've not been able to build some kind of a structured, what do you say, a quantitative framework to monitor your investment that aligns with your philosophy. What should be the right approach to really align that together? Actually?
Uh,
Thank you.
Again, I think it's a good question. I'm not really sure whether I would be able to answer it well, but that reminds me of the story of Michelangelo, who created this sculpture of David. And someone asked him, "How did you actually build David?" And he said that I simply removed everything that was not David. Right. So in the same way, when it comes to investing principles and framework, right, something rather than focusing on what works, right, I would rather focus on what does not work for me, because there are more things which are not going to work for me, or more things that I don't believe in, or they don't suit my personality as far as investing is concerned. Right. So if you remove everything that doesn't suit you as an investor, right, you are left with a framework automatically. So it's more of an inversion. It's more of what Taleb says via negativa. You remove everything that you're not comfortable with. So as far as my framework is concerned, again, focusing on businesses, I'll avoid businesses that have leverage on the balance sheet. I'll avoid people that have short-term focus, or business owners that have short-term focus. I'll avoid businesses that don't have capacity to suffer. I'll avoid businesses that are earning less than their cost of capital, right? So if I avoid all these kind of businesses, I'll automatically create a framework of finding businesses that suit my personality and suit my profile. So rather than focusing on how to build a structure, just remove everything that is not going to be the structure, something that you don't believe in, and I think you'll automatically form a framework for yourself. And that framework evolves over a period of time. So initially, when I created my framework for investing, I avoided everything that was having even a small amount of debt on the balance sheet. So I wanted clean, spick and span balance sheet, which I still want. But over a period of time, I realized that I made a lot of mistakes of omission by avoiding businesses that had, say, zero point 0.5 times or 0.7 times debt to equity, which were having enough profits before interest to be able to pay interest. So there was a lot of comfortable interest coverage out there. They were generating good cash flows. And probably they had taken debt for some time to build up capacities or to grow their business, and the benefits are going to accrue in the next few years after they had leveraged their balance sheet to a certain extent. So gradually, my process and my framework changed to even looking at businesses that had less than 1 time debt to equity, but had enough cash flows and enough profits to repay the interest and debt when it came due. Right. So I think the framework, again, to make it short, right, removing everything that would not be a part of your framework, removing all kind of businesses that you would never want to own, you'll automatically come across a framework that suits you, and then you need to keep evolving it, because you change, not because others are making money using different frameworks, but because you change, your thinking changes. So that is, I think, I answer your question. I hope I did that.
Yes, you did it. Thanks so much for that. If I can ask a follow-up question, but ultimately you would want to track and benchmark that maybe you. I'm not saying with the likes of NSEs or the BSEs. You may have your mental benchmark that I want to achieve this kind of a rate of returns for me to be comfortable actually. But again, unless and until you build a framework, quantitative framework, it wouldn't be your whatever qualitative framework you may have wouldn't give you that result actually. So my question was like, I've not been able to design a framework for myself so that I can say that whether I've been able to achieve or be closer to the benchmark I have.
No, I think the benchmark for me, the only benchmark is inflation. Am I able to beat inflation, long-term inflation, or not? So that's also takes me to the same answer that I try to find companies that are so good that they have some kind of pricing power, whether it's high inflation or low inflation, they are able to be profitable. They are able to earn good return on capital employed in even in a high inflationary environment. Though they may see pressure, they are businesses. They face competition. So if I only focus on businesses that can do well in an inflationary scenario as well, right, and businesses that can do well over a period of time, my only benchmark is I would want to beat inflation, and that's it. Not any index, not a fund manager, just the inflation. That's it.
Understood. Thanks so much.
My pleasure.
Thank
Thank
you,
you.
Saurabh. So before coming to Old Monk and Mukeshji, so Vishal sir, like you already have written three books and the fourth one is in pipeline. So would you like to tell us about like what we can expect from these books and what was the thought process behind these books?
Okay, so the first book actually so the first two are the e-books. One is on mental models. So we've written a lot of stuff. In fact, Anshul, if some people may know, used to work along with me, and he wrote a lot of articles on mental models and behavior and all this kind of stuff. We compiled that into the ebook, so there are around 50 plus mental models. There are another 50 more that we have written on the website. So there are like 100 plus mental models out there. So we compiled that into a book, which is like a 400-page ebook on mental models and how do you associate that with decision making and investing, which is it has done well for us. So that's one book. The second book is using lessons from Munger and Buffett to create stories for children. So I found that there were so many lessons which even kids can learn from the likes of Buffett and Munger, but there were not many books, or there were not any books out there who could teach them in the language. So I wrote a book which is called Two Wise Men, where we pulled out quotes from Buffett and Munger, and we've created stories for children around that. So that's the second book. The third book, which is the first printed book or first hardcover book that I wrote, and I self-published it last year, is called The Sketchbook of Wisdom. It's more about life wisdom. There are five sections. Three of them are dedicated to living a good life. One of them is about money and personal finance, and how do you manage yourself as manager of your money, and not really how to invest. It's more about the philosophy of managing your own money and being frugal and avoiding leverage and avoiding debt and etc. And of course, one final section is on how to make good decisions. So I talk about a few biases out there which hurt us as decision makers out there. So that is one book which I cherish the most. Yeah, so these are the three books which are already out there. The fourth book, which I am in process of writing, I was supposed to release it this year, but I think it would go to next year, of course. It's called Shut Up and Wait. The title of the idea, or the idea of the title, came from Morgan Housel. He actually tweeted a couple of years back a long-term chart of the S&P 500, which was a single way ride over a 100-year period. And he said that if there is one book which can tell you everything about investing, it would contain only one chart and one page, and the title of the book would be Shut Up and Wait. Right. So since I could not find a book with this name, I requested Morgan, if he is wanting to write this book, he can write. If he is not, can I take the title? He readily agreed. And I took the opportunity of writing this fourth book of mine, which is called Shut Up and Wait, which should come next year. It's again largely about investing principles, about how I look at investing, about what really works in investing, what doesn't work. So basically, it's a manual for myself. These are notes for myself, which I've written over years, which have helped me become a better, saner investor. And the book is just my way of sharing it with others. So, yeah.
Really interesting and looking forward to it. So, one last question from my end before I allow three speakers. So, Vishal sir, like the idea of the 1% show, how it came, what was the thought process? And again, you have interacted with various minds across the globe, right? So, how had been your experience, and what were the main learnings? If you can point out two, three main which you like the most, yeah.
So there's no, I don't trace the genesis of this idea actually. So everything like I mentioned earlier, right? Everything that I've done on Safal Niveshak and with my work is like uh, I I wake up with an idea and I put it to practice, and something that I think would make me happy. Not only something that is going to earn me a lot of money, but importantly something that is going to make me happy and keep me happy. So I have been wanting to do a podcast, video, YouTube, and everything, but I am too shy of coming on camera and talking to no one but a camera in front of me. I probably don't have the ability. I'm still trying, but I'm not really sure. So I've had requests from a few friends and people out there who suggested that I could do some kind of audio podcast and inviting people and interviewing them. Right. So I deferred that for a long time, but then last year I got an idea that this is probably a time to do it. And I think it was May or June 2021, where I decided to launch the 1% show. The idea of the show is the original idea of the show, and it still remains, is to go beyond investing and to focus on the lives that people have lived, and people with a lot of experience, not people like me who are just like 30, 40, 40 years of age, but people who've lived like 50, 60, 70, 80 years of age, and learn the life lessons, the decision making lessons, the key lessons, the key mistakes that they made over their lifetimes, because that is probably more than what a book can teach you. So I've done around 24, 25 sessions so far. I've been lucky enough to connect with a lot of wonderful, wonderful people out there. There have been a few. Everything is my favorite. So there's so much learning which is out there, which I could not probably could have found in multiple books out there. But yeah, the learnings have been great. If I were to just name a few lessons out there, I think one of my biggest learning by conducting these podcasts with such wise people is that as you grow old in age and you combine that with value investing of thinking like an owner, thinking long term, and everyone that I have interviewed on the 1% show fits that category. That makes you generous, right? So people have been generous with their ideas, and people have been generous with their time. Uh, People like William Green, who spoke for like 3 hours on my show, they could have chosen to do something more precious, more better with their lives than that 3 hours, but they chose to be on my show for 3 hours. People like Arnold Vandenberg, who's like 87 years old, who kept standing for 2.5 hours speaking to me on my show. And my first question to him, his response went on for 2 hours 20 minutes. So I could not really interrupt him to ask my second question because he told his entire life story in that one thing, right? So I've relearned the idea of not having a purpose in life except being useful to others, and rather looking at life as a river that you just keep flowing rather than knowing which ocean you're going to end up, right? So that's one lesson. A lesson on investing, which I remember the most, came from my second episode with Vinod Sethi, where he said that we should separate analysis from action, which simply means that if we have analyzed a business and if we finish analysis, does not mean that the very next day we should go and act on that analysis. Right? His idea was that there could be a time lag between when you finish an analysis and when the market offers that opportunity. You have to let the market whisper in your ears when that opportunity is right. And it's not about timing the market, it's about knowing when is the right time to invest in that business for a long period of time. So that's one lesson which I have learned. And again, the idea of giving back to the society what you've learned. And this is something which I seriously lack. And this is probably my grouse and my grief with a lot of Indian investors out there, that probably we also need to learn something from the West as far as investing is concerned. They need to give a lot, and you guys are doing that. There's so many people out there who are generously sharing ideas. So I love when people generously share ideas without understanding where the other person is coming from, without understanding, without really differentiating between your level of wisdom and the receiver's level of wisdom. Right? They're just sharing ideas, insights, and they're so generous out there. And in fact, if I were to go back to William Green again, who spoke for 3 hours, I highly recommend his book Richer, Wiser, Happier, which I read once before talking to him on the show, and once after I talked with him on the show. And the second time when I read it after talking to him, the book made so much more sense. It made great sense in the first time as well, but I could really sense what William is all about, what long-term investing, what value investing, the kind of people that he's profiled in his book is all about. So I highly recommend that book to you. So again, I cannot pick and choose between any particular podcast. Everything has been great. But yeah, the biggest lesson is people has been generous. There is one big lesson that value investing teaches you is to have long-term focus and be generous with your ideas. So yeah, so those were the lessons, and I enjoyed in these sessions.
Great, great. And even like I heard the recent, not recent one, but the one with Kuntal Shah sir. And sir, I just wanted to know how you approach. Most of the people I see are, I mean, they're not much open in the public domain, and they are kind of reserved in the sense like they do not appear in public. So how you convince those to come to your show? On the second part is like, what are your preparations before hosting them over your 1% show?
So how they agree to be on my show, I don't know. Probably they're too generous, and I am also very lucky out there. So, but I think if I were to just take some credit for it, I think because these people are investors or related to investing, they have been in the markets. Somehow, probably they understand the kind of work I do and the kind of things I bring on table. So I see a lot of people agreeing to me, and I'm surprised when they tell me that they have read my work, and too humble to understand that they have got time to read my work over the past many years and they have liked it. So that's some great feeling out there. And I think, as I mentioned, people are kind. So there are few people who I got connected with through friends and references, but they were kind enough to give me time to speak. So I think it's a matter of luck and hard work for the last 10 years, 11 years, which has helped me. Second is any preparations. Yeah, there has to be preparation because I am talking to such wise people. So I have to be ready, prepared. So if there's any book on them, I read. If there are any resources on them, online, offline, I come across. Or they are on Twitter. I go through all of them to prepare my questions and try to ask them questions which they have probably not answered in the past, or a different version of a question that they've already answered, but for a newer audience. So there's a lot of preparation which goes into framing the questions, because I should not be asking or should not be asking them the same kind of questions which are very generic and not get anything meaningful out of it. So I don't want to make sound unique in my questioning, but I want to sound authentic. So I need to know very well what these people are all about, what their philosophies and biggest learnings are all about, the kind of mistakes that they make, and my questions are all around that. So there's this broader template which I have, and I try to create my questions specific to that person using that broader template.
Great, great. So there is one question from Old Monk. He got dropped, so he has written that. So basically, he's asking about when it comes to value investing and momentum investing. See, when the capital base is low, which one should be preferable? Because there are opinions like when the capital base is low, you can go for momentum trading so as to increase the base, and then you can think about preserving your wealth. So, what's your view on this, sir?
Momentum trading or investing is outside my circle of competence. I have no idea about there, but all that I understand, and again, I don't know the person who's asking the question, but all I understand, my generic advice to people is, or the question which I ask them is, why do you really want to grow your capital using the stock market and grow your capital to invest more, right? You could rather spend your time working hard, creating a alternative source of income outside stock market, or working hard at your job or your work so that you earn more and you save more and live a frugal life and invest that money to create capital, and grow your wealth from stock markets or stock investing over a period of time. So again, the idea of creating capital using trading or momentum, um, I don't really believe in that, because probably that's my understanding. But I think there are a lot of risks out there, again, because here you are thinking short term, you are thinking stock prices, and you want to earn money to invest in businesses for the long term. I cannot have that mentality of having two different kind of thinking in a single brain. So my lack of literacy over here really hurts me, and I don't really feel anything bad about myself. But again, my advice is that, or my question is that, why? First, ask yourself, why do you really want to create capital from momentum and trading to invest for the long term? You rather focus on your work and your passive source of income, your active source of income. Live a life which is frugal. Save money which is in your control, and invest that money gradually. The question is, why are you in a hurry, right? And if you are in a hurry, stock market is not a good place for you. Right? So I think it was Professor Sanjay Bakshi who wrote a wonderful post many years back talking about a concept called return per unit of stress, where he said that for the kind of alpha or the kind of return that we are seeking, right, we forget the stress that we take, right? And if you want to increase your return per unit of stress, either you see your return rising, or you see your stress coming down, or you see your returns rising faster than the stress that you take, right? So I would rather, even if my returns are static and they are comfortable, I'm able to beat inflation, and I'm minimizing my stress. Personally, I would go for that strategy and not increase my stress for the sake of that incremental alpha, because in hindsight, when you look back 30, 40 years down the line, you would not really think that that really mattered. What mattered is how much less stress that you took in investing, and you focused on your life outside investing, your family, your work, your relationship, and everything, right? I think uh, uh, this is another lesson which I practice myself. uh, People look at stocks and people optimize for returns, so they're going to seek investments that give them the maximum returns. I look at stock markets and investing as optimizing for happiness, rather than focusing on what stocks or what businesses will give me the maximum returns. I would rather look at businesses which I'm happy partnering, or managements which I'm happy partnering as business owner for a long period of time. So optimizing for happiness and not for return is my personal investing philosophy, and this is what I advise. I may be wrong, and that's the reason I don't go out and advise people generally. I only advise people who I know. But my generic advice is optimize for less stress, for happiness, and not for returns. And focus on your work, take care of your savings because that's the only thing in your control, and gradually invest that savings sensibly to buy your own businesses which are good, which are going to create wealth for you. But your main wealth is going to come from your savings and not from stock markets. Stock market is only going to compound that, right? But your main wealth would be created depending on how much you save and how frugal you live, while keeping a balance and not saving and compounding everything for the future. That's my answer.
So Mukesh ji, you can unmute and ask.
Yeah, Vishalji, good evening.
Good evening.
Uh, but I want to say something, and because I feel I am an aggressive investor, and thing is that I don't have time to pick up the stocks from the market. So I want to invest for long term, but I am an aggressive investor. So my suggestion is that shall I go for a small cap funds or any PMS fund? Anything is there so that I can be an aggressive investor and for long term.
Okay, so what's your question?
No, my question is that I want to invest for a long term as an aggressive investor, but I don't have time to pick up the stock directly.
No, so if you don't have time to pick up stocks, then you go via someone else. So your question is, should you pick up a mutual fund or a PMS? That's the question.
Yeah, yeah.
Yeah. So see, PMSs I'm not comfortable based because the costs are too high, right? Most of them will charge you 2% of the money that you give them and 20% of the return above a certain hurdle rate. So the costing doesn't really work in your favor in most cases, right? Though there are individuals or small companies, at least individual investors who are very smart, who run PMSs of their own, where the cost structures are not stringent. If you can find them, you may invest with them. Mutual funds are better off for people, maybe a small cap fund, or maybe, I don't know, the kind of fund that you want to own, you're comfortable owning. But I am not really sure what you mean by being an aggressive investor. Aggressive investor, do you mean you want to earn return fast, or you want to bet on businesses which are small, like you mentioned, small caps, and can do really well over a long period of time? So
No,
aggressive investors, I don't know whether they're aggressive investors. I only understand that Ben Graham gave this formula, or not formula, differentiation between defensive and enterprising investors. So enterprising are people who are willing to identify stocks, maybe small caps, mid caps, large caps, whatever it is, right? Defensive are people who are focus on more long-term strategies and focus on portfolio allocation, and not really worried about picking the small cap or penny stocks or micro caps. They focus on well-established companies out there. So it's mostly defensive and enterprising. I'm not really sure what do you mean by aggressive.
I mean, aggressive means like continuous CSR like 20% and above, and it will continue for long term.
You have no control over that. So 20% first is difficult. We are not living in such a high return world anymore, right? They are all intelligent people out there. The moment the market falls, people are there to buy stocks, and most people will not have an opportunity to own stocks at their desired price levels, and so they may not earn a 20% CAGR, which is, I think, too high a return that you're expecting. So probably my advice to you is to tone down your return expectation, right? Because again, as Buffett says, that the secret of happiness in life is to keep low expectations. If you already start with 20% expectations, I think you would be disappointed a lot. I would not, if I were your friend, I would not advise you to chase 20% return. I would just advise you to focus on much more reasonable number. Give your money to a mutual fund, start SIPs, and just think for the long term and focus on your work. So I would advise you that 20% is too high a number, in my opinion.
So, Vishal sir, like we talked a lot about investing and all. So there are bigger aspects of life except investing. So would like to know. I mean, going forward, what are your plans for we can contribute to the society, which can be beneficial for them, say down the line, say next 10, 20, 30 years down the line.
You're saying, what are my plans to do that?
Yes, sir. What are your plans and what we should, I mean, ponder in later life so as to contribute to the society or maybe from initial years as well?
Yeah. When I was in school, when someone asked me what you want to do in life, I said I want to change the world. Right. So when you are small, when you are young, you want to change the world, and gradually realize that this is not in your control. All you can do is change yourself. Right. So comparing that with my previous response of not focusing on goals but focusing on systems, if I can try and become a better human being on a daily basis compared to what I was yesterday, I think that will be a useful contribution to the society. As far as my work is concerned, I think since I believe in the kind of work that I do, if I can just keep on doing the same kind of work in different ways, right, maybe through a podcast, maybe through articles, maybe through books, but maintaining the integrity of the system and not really compromising on that, right? If I can just keep on doing the same kind of work, I realize that the compounding is going to work in my favor as well, and ultimately in the favor of people whose lives I'm able to touch by just being useful on a daily basis. So I think that's my response on what my plans are. There are no plans, right? If you ask me what I'm going to do tomorrow, what am I going to write tomorrow or read tomorrow, or the next product or service which I'm going to launch, I have no idea at all. So just being useful on a daily basis is all I believe in, and not diluting the integrity and honesty with which I work. So that's my long-term plan.
Great, sir. So, sir, apart from the two wise men, who you think could be a third name who has influenced your investing process and framework per se?
Uh, there are so many people. I think so. First two is clearly taken, right, by Buffett and Munger. Again, in Buffett and Munger, I cannot say who's first and who's second. Maybe Munger is one and Buffett is two. Buffett is two. But there are people out there, and they are beyond investing as well. So maybe it's Swami Vivekanand, maybe you have Marcus Aurelius, maybe just reading the Bhagavad Gita. There's so many lessons out there. So Bhagwan Krishna, right? In today's world, you have people like Nassim Taleb in some ways. You have Naval Ravikant out there. People I have interviewed on the 1% show. I would want to live like I want to behave in life like Arnold Vandenberg. Not many people know him. If you don't, please go and listen to the podcast which I did. And there's so many, I think a few other podcasts on Arnold Vandenberg out there. So there are so many people out there, and I take lessons from all of them. I try to bring them on my show as much as I can, but there's so many out there, so many out there. And I find the older I get, I realize there are the more people outside investing that I need to bring into my life than inside investing. Inside investing is being taken entirely by Warren Buffett and Charlie Munger, because I don't find any other incremental lesson that I can learn from others. But outside investing, there's so many people out there. And even if you go back and listen to the archives of the 1% show, there's so many investors that I've interviewed, but all my questions, most of my questions are non-investing stuff. because I want to seek their ideas and wisdom on non-investing. Investing is all there out there. There's nothing new to learn.
All right, sir. So one last question. So it has two parts, sir. So one best advice you have got so far in your life, not only limited to investing, but life as a whole, and one advice which you want to give us to all as a whole. Yeah, over to you, sir.
So I think you mentioned that advice, which I have already mentioned in the past, is that whatever I do, I need to do with complete integrity. So that someone senior advised to me many years back, even before I had read Warren Buffett, who said that when he hires people, he looks for three things. One is energy, the second is intelligence, and the third is integrity. And if the third is missing, which is integrity is missing, he's not going to hire that person, because energy and intelligence only is going to destroy him, right? So he's looking at integrity as the foremost thing. So that is something which I have received as an advice as well. What I would want to tell you or your listeners is, I think there's nothing new that I should tell, but I think the thought which I believe a lot in is what Munger says so often, is all I want to know is where I'm going to die, so I will not go there. So avoid things that can kill you financially, emotionally, or otherwise. Build in buffer, build in margin of safety in your life. Have a long term view in a world which is focusing on the short term, because that is going to separate you from others, right? When it comes to investing, think like an owner, right? And have patience. I think with time, I think, as they say, is the biggest healer. Time is the only thing that is somewhat in your control in terms of how long you invest, and how long you have a view on businesses and investing and your own life. And just take it one day at a time, rather than focusing on goals. Just focus on what you can do today. Just focus on your process. Goal is never in your control. So why do you even think about that? So just focus on what you can control, and build a system that can help you to be the kind of person that you want to become. So those are my ideas for you.
Great, great, sir. So we close with your last thought on the India story, and what are the mega trends which you see can be for say next 1 or 2 decades, where we can, I mean, that could be a starting point for us. We can study and we can be long on India on those fronts, basically.
No, I think the simple underlying thesis is that India is going to grow. So if India is going to grow, there are a lot of, I don't know which sectors are going to do well. Of course, consumption, manufacturing, everything is going to do well. But again, within that, which companies are going to do well, I've not really much idea. I still need to go and find those businesses out there, whether they are within my portfolio or outside my portfolio. But the fact that India is going to grow are going to create a lot of wealth for people who have that patience. So a lot of people say that India has a lot of legs to grow in the future. The only question you need to answer is whether you have the legs to carry on with the India growth story for the next 20 years. If you're trading in and out on a daily basis, despite knowing that India is going to grow for the next 20, 30 years, right, then why are you doing that? So if you believe in the India growth story, you try to find out those businesses that are going to do well with the India growth story, right? And you just partner them for the next 20, 30 years, and you'll do well. So mega trends, I think India itself is a mega trend, right? It has been a mega trend for many years now. We've talked about infrastructure. We talk about banking, financialization. We talk about technology. So some or the other flavors of the season will always be there, right? You don't have to worry about them. Own a reasonably diversified portfolio of stocks and equities, and I think you should be fine. You should do well. Just avoid the things that can kill you, or just avoid capital intensive businesses. Just avoid business with leverage, because they could die down and you could lose your money permanently. So if you avoid the big losers, the reasonable gainers should do the hard work for you, and you should retire happily ever after.
Great thought. So thank you so much, Vishal sir, for your time, and it's almost more than 2 hours. You are continuously speaking, so it was great insights from your end, and so kind of you to agree to my request. So, any last piece of advice for me, so as I mean, I also try to bring the best minds in the industry, so as to educate myself and as well as our attendees. So, any advice you want to give me?
Yeah, first advice: diversify outside spaces. Move to other avenues, because you don't know when Elon Musk goes spaces down. if he's listening, he may close it down tomorrow as well. So maybe find out other alternatives like Zoom or other areas where you can invite people, if not spaces. Create your own medium out there. So this is one lesson for me, is to have margin of safety, right? And work on platforms, work on things where I have a greater control over compared to external stuff. And that's the reason I run a blog and maintain a blog, and not really dependent on too much of YouTube or too much of Twitter out there, except to share my ideas, right? And also host my podcast on a different platform rather than depending on one single thing. So I think and I think you're doing great. So just keep on doing it. I think you'll benefit from the power of compound to be able to invite so many wise people over years. You've already done that. So except today's session, sorry, but just keep doing your work, Prince. I think you'll do well.
Well, thank you so much, sir. And it was so nice and humble of you, so as to guide us on all the fronts. So look forward to more sessions down the line, sir. And it was really insightful on your part. And the session is recorded, so we'll be putting it on YouTube as well. And I'll share the link so that those who missed it live can revisit the great session today. So thank you once again, sir, and thank you.
Thank you, Prince, and thank you to everyone who's being patient enough to listen to me for like 2 hours now. So thank you so much.
Great, great. And I think we covered almost all the questions which were there in the comment section, those which were direct stock specific. So I think we did justice to everybody's questions, and thank you so much for that, sir. And with this note, I take your leave. Good night and take care.
Good night and take care, you too. Thank you, guys.